there are some standout pockets of outperformance as well. It was a turnaround quarter for Equitas Small Finance Bank. The lender reported a healthy growth in advances, robust traction in low-cost deposits. Headline asset quality too improved. To understand what worked for Equitas in the fourth quarter and whether they can emulate or better this performance in the quarters ahead, let's welcome in Mr. Raghavan HKN, President of Outreach and Inclusive Banking at Equitas Small Finance Bank. He joins us right now on the show. Good having you, Mr. Raghavan. Thanks so much for taking the time out. Arguably your strongest quarter since Q3 FY17. I mean, I look at the bottom line numbers, look at the GNPA numbers and tally them with what's happened in the previous few quarters. It's been the best performance in the last 5 or 6 quarters. What went right this time?
I think definitely this particular quarter was a standout. Predominantly, if you look at it, we didn't have the hangover of the provisions and NPAs in quarter 4. Because in quarter 3 we had provided completely for microfinance included portfolio, which was roughly around 140 crores and which was written off in the quarter 4. And thereby the NPA, GNPA numbers fell from 4.95 to 2.72. So if you split this into parts, if you look at it, microfinance, which was at 6.9, has fallen down to 0.72 in terms of GNPA numbers, and also non-microfinance, which was 4.11, has reached down at 3.44. So overall, there has been a very good performance in terms of the GNPA numbers, and it has resulted in a 35 odd crores of profits. And again, going back to the growths that you're talking about, till first half, we had the hangovers of the demonetization issues, especially impacting the microfinance business, and also the GST, which also kicked in. And we were roughly around 2% growth in the first half. Second half was extremely good. The markets picked up. The GST issues were behind us. Microfinance traction started picking up. If you look at the portfolio, which was falling down pretty sharply, has settled down in quarter 4. And as a business strategy, we wanted to also de-risk in terms of the one particular product, which was microfinance, which is now at 28%. And we exited March with almost 12% growth. So that was the kind of story.
Okay, so there were some one-offs in the MFI book as well, but just broadly, what is the vision of the management at Equitas? 12 months out, 18 months out, 24 months out, how will the mix between MFI and non-MFI change? Because your non-MFI performance this quarter on almost all parameters was quite exceptional.
We had, as a management, as outlining, it was very clear that we had a strategy of bringing down the microfinance portfolio to below 30%, which we have achieved now. And this year also saw introduction of 4 new products, which is non-microfinance products, which is starting from agri loan, business loan, MSE, and loan against gold. And all these 4 products have also had a very good traction and now contribute 15% to the total portfolio. And the non-MFI portfolio grew almost all with 52%. But if you look at the space at which we operate, it's completely informal sector. In the last 4 to 5 years, we have developed an expertise of assessing this completely an informal sector where you can't have a cash trail or a banking trail completely. So this has been the ability of non-microfinance products, ability to underwrite the informal sector. As you know, the informal sector is quite large, the penetration is pretty least. So going forward, we will leverage on our ability to assess the informal sector product, clients. And also it's important that we keep the product portfolio pretty good. The NPAs in this portfolio is roughly around 1.1%. So it looks like a huge opportunity, and growth should not be a problem at all because the opportunity exists and we have the ability to grow this particular sector.
But the mix would stay roughly 30-70, or would that be a change there 2 years out?
More or less it will stay around 30-70, and what that entails is that the microfinance will also have to grow. It's not that it will degrow, the microfinance will also grow, but that will grow roughly around say 30-35% plus, whereas the other products might definitely grow faster than the microfinance, so that the portfolio mix remains what we have planned for.
But in which case the book size or the book mix will change, right? If the other mix, which is 70% even currently, I mean, I believe your FY18 share in advances is down to 30% for the MFI book, if I'm not wrong. So if that piece is growing faster, wouldn't the overall mix change 2 years out?
Yeah, definitely overall mix will change, and in terms of microfinance, probably another 5 to 6%. There could be a dip in terms of contribution, but microfinance will also grow as a portfolio.
Okay. Fair. A couple of other questions on two parameters where you've scored well this quarter. I think the investors would want to know whether this is a one-off or will it continue and in what pace. Firstly, your cost-to-income ratio. I've spoken to a lot of investors who invested in your stock, and all of them say that at some point of time there will be an inverted hockey stick impact on cost-to-income ratio, and the management will have to show that that in the print. You've shown that in the print this time around, wherein your cost-to-income ratio fell below specific levels, I think sub 77%. What's next over the next 12 months, cost-to-income?
Yeah, cost-to-income, if you look at Q4 was a first time where the cost-to-income ratio fell below 80, which is at 76%, right? And we have 392 liability branches, and those branches are completely operational. And if you look at the productivity of these branches, it is improving quarter by quarter, and which will have definitely a positive impact on cost of funds. So if you look at the growth in terms of deposits, it's roughly around 25%, 27% quarter on quarter. So the productivity improvement in terms of branches is going to be there, and by and large, we are not planning large number of branches, new branches in the coming financial year. So hence the cost should be definitely under control, which ultimately have to bring down the cost of cost to income ratio in the coming quarters to see.
What levels do you envisage? Say the same time next year when we are having this conversation, do you reckon the numbers could be 300, 400, 500 basis points lower or even lower than that?
Now, the Q4, which is the quarter went by, it really shows a 4% decrease, and it would definitely come down for sure. We need to look at how much percentage. It's very difficult to speculate at this point of time.
What about the NPAs? You've shown a fair bit of improvement in the GNPAs, net NPAs as well. What are the targets for FY19?
Our target will be definitely far lesser than what we have currently executed in this the previous financial year. GNPA numbers, it is at 2.72. One, the portfolio quality has definitely improved. Because of the economic activity, the repayments are also done extremely well. So hence these two factors put together, and definitely the GNPA numbers will be far lesser than 2.72 for sure. It should be roughly around, we would expect it to be around 1.8 or 2%.
Okay, what about the cost of funds? I think the last time that I spoke to Mr. Vasudevan, if I'm not wrong, he was non-committal. I mean, while other companies have said that, oh, we have this fantastic book and fantastic rating, and therefore the rise in yields will not impact us, I think Mr. Vasudevan was categorical that yes, there will be an impact on cost of funds. What is the situation right now, and how will it shape up to your mind over the course of the next 12 months?
I think from a cost of funds perspective, quarter on quarter, the cost of funds have fallen. The cost of deposits that we are raising is around 6.5% as of now. And overall, put together, total borrowing cost is about 8.1%. And the raising cost of deposits might definitely push the cost of funds to some extent. To what extent we have to look at, because how we are able to manage the client deposits and plus the borrowing will only play out as to how much will impact our cost of borrowing.
Okay. We talk about how the Indian household, average household, the debt to GDP is so low compared to some of the other emerging markets, and therefore the room for growth is quite tremendous. My question to you is, to your mind, here on, say, 3 years out or say 5 years out, which is what the management would be thinking of. You wouldn't be thinking quarter to quarter, even though you talk to us quarter on quarter. What's the growth in the size of book that you envisage for you as a company, say 3 years, 5 years out, looking at the lending or the borrowing super cycle, if I can call it that India seems to have embarked upon?
One of the biggest strengths of Equitas is product assessment, underwriting of informal sector. We are built very clearly. And the other side, the opportunity in terms of informal sector, be it a small size business, micro businesses are pretty huge. The NSSO survey of 2003 indicates about 51.5 million smaller ticket business units, which require roughly around 2 lakh of ticket size. that's the kind of a requirement which trans out to about 12 lakh crore of an opportunity, right? That's pretty huge. And currently the penetration is 4%. While one side is a huge opportunity, the other side as an organization, we have developed the capability of delivering, growths in this particular credit to this segment, which has to give us a consistent growth on about 35% plus year after year. So that should actually translate into the kind of portfolio that we are talking about. And challenge is that how do we keep this particular portfolio quality intact? It will be a challenge. But otherwise, next 5 years, definitely is a huge opportunity for growth. And we are there in that space where very little competition is there. So hence, growth should not be a problem at all.
Sorry, just last question. I'm just, and we have the other management on the line as well. But did I hear you say 30-35% growth year on year for the next 3, 4, 5 years?
Definitely, that should be possible.
That's the bare minimum, you reckon? There is a chance
Yes.
of this surprising on the upside as well?
Upside, definitely there is a chance, but at least we should look at 30-35% as growth.
Okay, you're being very cagey, Mr. Raghavan, or maybe let's say being very conservative, or in at least your comments, but appreciate that. Maybe that's the nature of the business. Thank you so much for taking the time out. Congratulations on a good quarter and all the best for the year ahead.
Thank you. Thanks a lot.